The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, happy Thanksgiving, everybody. Oh, no, it's Happy New Year, not Happy Thanksgiving. Anyway, Happy New Year to everybody. Maybe tomorrow will be Thanksgiving, though, you think?
Well, it could be Christmas if the Bills win.
Well, I mean, I'll be very thankful if they win, right?
It would be the biggest, wonderful.
It really would be. It would be Thanksgiving to me tomorrow night. Anyway.
Actually, today we should know, right, Chris?
Well, yeah, one of the teams.
Well, a couple of the games today, right?
And
yes.
we'll know after a couple of the games.
Right. So. Anyway, I'm Esther Gulius, the tax lady from EG Tax. It's tax season, everybody, and we're here to help you to make sure that you don't overpay your taxes and you get the biggest refund possible, and you know all the angles so that it benefits your finances. And I'm joined in studio with, obviously, Tiffany Fabian. Hi, Tiff.
Hey, happy Saturday.
Happy Saturday to you, and Christopher Fabian.
Hello, Esther.
Hello, Christopher. Okay, so we want to talk about something that it really just became law a few days ago, but it potentially can cost regular people a ton of money, and I want everybody to pay attention. It is called BOI, which means Beneficiary Ownership Reporting, required by FinCEN. And FinCEN is the Financial Crimes Network of the Department of Treasury. So this is pretty important, right? Yeah. All right, so here's the thing. If you have an LLC, now think about that. If you have an LLC on your rental property, if you have a small business that's an LLC, or a partnership with 20 or less employees. So those are small companies, right?
Yep.
And
Yep.
you think about it, right, with rental property, you might have 6 LLCs.
Yeah.
So under the change in the law, you must report who is the primary benefits of those limited liability companies, 1120S's, or partnerships with 20 or less employees. And if you're the only employee or you're the owner, then that's 20 or less. You have to report to the FinCEN network, the BOI, the Beneficiary Ownership Reporting of FinCEN. Now, if you don't, and if you just start your company this year, you have 90 days to report. If you don't report to them, the penalty is $500 a day until it gets to $10,000.
That means 20 days.
In 20 days, right.
Yeah.
So it is really important, and I just can't stress this enough, that if you got a limited liability company, that could be on rental properties, it could be on your Avon business, whatever, with 20 or less employees, a subchapter S corporation or partnership, and that includes attorneys, right?
Yep. Yep.
So you have to register. It doesn't cost you anything to register, but if you don't register, the penalty can be up to, in 20 days, it would go to $10,000.
Right. And like you said, new businesses, meaning from 2024 on, have 90 days from the date of forming it. Pre-existing businesses have to the end of the year.
Right.
So.
Right.
They give them a little leeway.
We want to make sure that everybody understands, if you are a small business owner, limited liability, 1120S, or partnership, 20 or less employees, you got to get this done. And if you need help, we can help you. So you would go to the BOI FinCEN network. So it's BOI FINCEN.
Right, and you need licenses for all the shareholders.
That's
because
right.
you got to scan them into the system, or
Driver's licenses.
driver's license, or
Right.
passports.
Or passports,
Some
right.
state or federal government issued picture ID.
Right. So if you need more information on that, I'm going to talk about that on Monday on WBEN in the morning with Susan Rhodes and Brian Mazurowski. But this is so important. We wanted to make sure that everybody understands. If you know anybody with a small business, rental property, and there's a lot of people that might say, this is not important. I wouldn't want to have to deal with the Treasury Department with the $10,000 penalty.
You blink and it's $10,000.
Right. That's right. Okay, so I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. By the way, what do you think about that? Now, remember, this is the Financial Crimes Network of the Department of Treasury. This is not to mess around with. Okay, let's go to the phones. We got Mike. Hi, Mike. How can we help you?
How you doing, Esther and company?
Yeah.
Question. It's just got a little twist on something you guys always talk about. If I know there's a limited lifetime gift thing, which I'll never have to worry about unless I win the lottery, but I do have a house I bought from my grandparents' estate at least 20 years ago, 20 give or take, and it's going to one of my sons, and they're all aware of that when I die. So there's quite a bit of appreciation in it. It's a single 3-bedroom. But anyhow, can I give that as a gift before I die? Because if it goes in my will, doesn't he have to pay appreciation tax on it?
No, actually, it's just the opposite. So
Okay, go ahead.
that if he inherits the house through your estate, then if he sells it right after inheriting it, he would get a stepped-up basis and pay 0 taxes. If you give it to him as a gift, then it goes back to your basis, the 20-year-ago cost, and if he sells it for $200,000 and your cost was $50,000, he ends up with a taxable $150,000 gain. So it's much better for him to have it go through the will.
Okay, he's never going to sell it for a while because his mom actually lives there. You know, she's going to be 73 this year. And,
Okay, but when he does, but let's think about this. If you paid, let's say, $50,000 for it, and it's worth $200,000, and his stepped-up basis would be $200,000, and he doesn't sell it for 4 years, maybe he sells it for $230,000. Then he only has a $30,000 gain. If he does it the way you're talking about doing it, he'll have a $180,000 gain. So, which is better? Obviously,
okay,
the
so
30.
as long as he's been living there 2 years and he sells it, then
Wait, does
no
he
big-
live there? I thought you said his mother lives there.
well, he lives and his mom lives there.
Okay. Well, then he doesn't have a problem because it would be the sale of his personal residence. And in that case,
Right.
if he lives there 2 out of the last 5 years, then the gain up to $500,000 if he's filing a joint return, $250,000 if he's single, is going to be tax free. So if he's living there, then he's not going to have a problem.
Okay, that's good. Thank you very much.
You're welcome. Happy New Year.
Happy New Year to
And
you
pray
guys.
for
Hope
them
it's
bills.
better than last.
Good planning.
Pardon me?
That was very smart of him to plan.
Yeah. Well, planning is the important thing, right?
Yep.
All right. The other thing I want to talk about before we get to our phone calls, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. What do you think about this financial crimes thing? You know?
Well, I understand.
It's sort of like
Go ahead.
It's like the same department that handles the FBAR, and the
That's right.
FBAR are foreign bank account reconciliations if you have accounts in other countries.
So talk about that too, because that's a potential penalty of $10,000 as well.
Right. So if you have an account in Canada, because we're in Buffalo, a lot of people do. Maybe you have family in Germany, Switzerland. You used to live in Australia, somewhere other than the U.S., and that money in that account is more than $10,000 US. You have to yearly report that to the government.
That's right. In the same different website, but it's FinCEN.
The same organization.
Right.
Yeah.
So the Financial Crimes Network, and that penalty can be up to $10,000. So again, if you have money in a foreign bank account in Canada, we love the Canadians, but it's a foreign bank account. You have to make sure you report that to FinCEN too, right?
So in my mind, it's almost just like they're more and more and more monitoring, and so that's, you asked me
and
what I
then
think
that's
about
why I
it.
want to talk about the 1099K on the other side. I know we got Kevin here. Hang on, Kev. We're going to take a short break, and we'll talk to you first.
We are family. I got all my sisters.
Hey, family, this is Esther Gilius, the tax lady, and we're talking about taxes and some of the things, the punitive things in the tax law, and they're very important because if this pertains to you and your situation and you blow it off, you could be looking at a $10,000 fine. So it's really important. If you're unsure whether you would be somebody that has to do this reporting under BOI, give EG Tax a call. We're happy to help. That's part of what we do.
It's not only that you have to do it too, but if the shareholders change, you have 90
Yes.
days to report that as well.
Right.
So
Right.
you really got to pay attention to your business now when
Right.
things happen.
And you know, the thing is, a lot of times when people do LLCs, they're just little thing, you know,
Yep.
they're little things, and they're just protecting themselves against lawsuits. Maybe they're a janitor or doing landscaping, snow removal, and you recommend, let's do an LLC to protect you. Now you got to also file with the Financial Crimes Network of the Department of Treasury.
That's what I said to Chris. I go, we should send out a letter to all of our corporations. And Chris says, yeah, but it's really hard to do because so many times people that have to file this are Schedule Cs because they're just single owner
That's
LLCs.
right. Well,
and
it's
so-
believe me, every Schedule C we do, we're going to make sure.
Yep,
All right.
yep.
And we're going to go to Kevin. Hey, Kev, how can we help you, sir?
Felicitations for the past Christmas season and Happy New Year to my
Same to you.
tax
Solicitations
family.
to you as well.
Thank you. Hey, question here. This BOI situation you just mentioned,
Yeah.
that some folks may have until the end of the year to do it. So let's just suppose, without giving too much detail, someone has like a hobby or a certain skill that every now and then, you know, someone calls them up during certain life events,
Right.
and they provide a service. They're not a registered company or anything, right?
No. These would be registered companies because these would be companies that registered through the state of New York as a limited liability company or a subchapter S corporation or a partnership.
Oh, good. So it's not like an individual person.
No,
Let's say
not
they
if
make-
you aren't an LLC or a 1120S or a partnership.
You're in
Okay,
the clear.
good. Oh, just needs to know that. Hey, have a great 2024, folks.
You
All
too,
right,
Kevin.
don't forget to pray for the bills.
Yes.
All right.
Forget to pray
I'm
for that.
Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 in a cell phone, and we have Dottie. Hi, Dottie.
Hey, Dottie.
Hi, Esther.
Hi.
My question is more of a question of property. My husband died a year ago. I paid $45,000 for my house. It's probably worth $500,000 now. I have done nothing except make a will to leave everything to my kids. And one person has told me that seems to know things that they will have to pay enormous taxes. Another person told me that the house is worth what it is the day I die and they don't have to pay taxes. What is the story?
All right, so here's the thing. If your children inherit the house through your estate, then they would get, as the law stands right now, and they could change the law, but right now, as the law stands right now, they would get a stepped-up basis, which means the fair market value on the date of your death would be what is assumed that they paid for the house. And as a result, if they sold it shortly thereafter, they would pay nothing or very little taxes at all.
Oh, very good. I never did do a trust, and somebody
you-
told me that was terrible.
Well, you don't need to do a trust. You could do a trust, but if you do a trust, then it becomes the asset of the trust. So you kind of shoot yourself in the foot. So
You
Go
could
on,
do
Chris.
what's called a life estate
Right.
to protect the house, and it's still your house. You get all the benefits for the STAR program and everything else, and it protects it from a nursing home, but your kids, when you pass away, still inherit it and get the stepped-up basis. So that might be something.
So
I
if you
should
just-
go
if
to
you
a
just
lawyer
wanna-
and ask for a life estate.
You can do that, or just put it in the will, whichever you prefer. The life estate, though, as Chris is pointing out, would give you retain all the benefits, but the great thing is, in the event that you have to go into a nursing home, after that 5-year look back, that house would not be an asset that they could attach if you had to do a nursing home. So that's something to think about. Very good planning.
It is a good thing to think about at my age.
Yep.
Okay.
So don't put
very
it off.
quickly,
This
I'm
is
gonna
the
tell-
first part of the year.
this-
New Year's resolutions.
Right. Well, with my husband's death, he died. Tomorrow will be 1 year, and
I'm
I'm
sorry to hear
finally
that.
learning that I've never done anything because he was like a CPA and did everything and knew a lot of stuff, and I did nothing.
Well, if you need
After
somebody
one
to talk to, we're happy to help
Also, Dottie,
I'm
the house was in both of yours and your husband's name, right?
you. Yep.
correct.
So then you actually inherited half of the house. So your basis isn't just the 50,000. Your basis is half of what it was worth when your husband passed away, plus 25,000 from the initial purchase price, basically. So your basis is probably around $300,000.
But of course, if you sell it, the first
250
$250,000
if she
is
sells it.
tax-free
Right,
too.
But it would also help her kids
Right,
if she did gift
absolutely.
it instead of the life
Right.
estate. So just different things there.
Okay, well,
Okay,
thank you.
Dottie, if you need help, give us a
Very,
jingle.
very good. Thank you. I
All right, thank you, dear.
appreciate it.
You're welcome. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Wanted to mention right now before I get the other calls and texts in, the 1099K form has, everybody can breathe a sigh of relief that had third-party pays like from Venmo or some of the other money people that would pay you directly for something like selling bills tickets. It was the law prior to this that if you had more than $600 in a year, they were going to send you the 1099K form. That's been changed. Now, if you have transactions of more than 200 or gross receipts of 20,000 or more, then they have to send you the 1099K form. But I've been getting texts in and people think, well, that means it's not taxable. That's not true. Just because you don't get the 1099K form doesn't mean it's tax-free. It just means that the payer does not have to report it yet.
Right. And I was listening to the sports station during the week, and they were talking about using Venmo for their fantasy football leagues, and I'm going, wow, that's right. All these people who do fantasy sports, who are the commissioners and would get all this money in, probably don't even realize they would have gotten one of these forms, and they would
But
have to
here's
put
the
it
thing,
on their
Chris.
and it may
But
not be
here's
taxable.
the thing, Chris. Is it taxable
That's what
even
I
though
just-
you didn't get the form?
That's what I know. Well, you still have to report the income, and
Right.
then you report the expenses. But
Right.
yes.
Right. So you still, because people say to me, I had one lady kept texting me back and forth, but I'm not going to be getting the form. So why should I report it? And I said, because it's taxable. You have to report the income that you receive for if you're selling something at a gain. It has to be reported. And, she didn't like that, but it's the law. So
Yep.
you want to make sure that, some of these IRS people don't come knocking at your front door, right?
Right.
All right, we have a text here, Tiff, right?
We do. So the text says, Esther, please tell me the difference between less and wait a minute. I'm
You're reading it wrong. Please learn the difference between less and fewer. You started the program this afternoon with the tax tip for LLCs with less than X number of employees, and it should be fewer. It doesn't look good for such an intelligent person.
Oh, well, thank you so much. I'm sorry. I guess I'm very colloquial in my speaking. So
or
it's-
they want you to be more colloquial.
right.
They want you-
So is it less than or fewer than?
Fewer than probably.
So it'd be
because-
19 or less.
Yeah, right. And then Dan texted in too. Every day we have with our families is a day of Thanksgiving.
Oh,
and then
but if
somebody
the Bills win, it really is.
somebody
It'll be
text
really.
somebody texted in, I love Kevin from Pendleton.
Oh, that's nice. He really is a great guy, isn't he?
Yes.
Kevin?
Yeah.
Okay.
There's
all right.
two
Do
mics.
We have any other texts here?
No, there's a text, but there's two mics. You want to take a mic before the break?
Yeah, I'll take Mike before the break.
There's
Hi,
two-
Mike,
two-
before the break.
Mike from Wheatfield.
There's two mics.
Yes. If you wanted to go to a tax preparer, what documentation would you need for the retirement savers credit?
Well, actually, when you come in and you present your W-2, because it's based upon earned income, then the next thing we'd need to know is, was there any contributions to any qualified pension plan? And that's that. We don't need the documentation. Many times, just looking at your W-2, if you're using a 401k plan, it'd be right on there.
Yeah,
So-
because it would have a D for money that you put in a 401k. So a lot of times it's on your 401k.
Yeah,
on
so
your
we don't
W-2.
require to see it, because obviously the IRS is going to get a copy of any qualified pension contribution anyway. But
what
if
would
it's
be
if
for-
it's something through your employer, it'll be right on your W-2.
Oh, it would be right on the W-2. Yeah,
Yeah.
for
That's
my
right.
daughter, she's single. Well, she's not a dependent, and I think her income's less than about 33. Or the AGI. is
Yeah,
like
so then
30.
she would
It's
qualify.
in box 12
Right,
or box
right.
14.
Well, that's my question. It should be on the W-2. How much?
It'll
she
be
can-
on the W-2.
box 12 or box 14,
if it's
Mike?
paid through her employer.
Okay,
Okay.
thank you.
Hey, thanks for calling. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We're going to break for the news, and we'll talk to you on the other side.
The bills make me wanna shout. Kick your heels up and shout. Throw your hands up and shout. Throw your head back and shout. Come on
Well,
now, the bills are making it happen.
You guys, I'll tell you, I'm really worried about tomorrow. Of course, I worry about every game, so, right. Let's hope the Bills win. It would be
Amen.
a wonderful thing, right?
Yes.
All right, and we're going to go to Mike, who's been holding. Hi, Mike.
Oh, hi, Esther. Thank you so much for taking my call.
Yes.
I had a question about the difference, and this may be a bit basic, but the difference between married filing jointly and married filing separately. And the reason I ask is my wife and I have a relatively large, about $100,000 difference in the amount of money that we make, and we both get W-2s. And the last couple of years when we were doing our taxes, we ended up owing quite a bit on the federal. And a friend of mine told me that he does married filing separate, and his wife gets a return, and then he ends up paying a little bit, but it kind of balances itself out a little bit better. And I was wondering if you could elaborate on that.
I'm the expert on that, aren't I, Esther? So I do lots and lots of people married filing separate, but generally, as soon as you told me it's not a good idea if your income is not even. Married filing separate is good if your income is about the same as your spouse. So I don't think it would be a good answer.
However, you should try both ways.
You could
right?
try. You certainly can try both
And
ways.
we have software that will tell you after you're done with the return how much you would save if you filed separately.
Yeah, sometimes it's better, like if you make so much money together that you start losing the child tax credit, so then we plop it on the one that's making less money. Sometimes if you have a big itemized deduction, things of that would behoove you, and I always try.
Right. You should always look at it in both situations. And like I said, our program shows exactly how much you would save if you file married filing separately. Sometimes it does save you money. Not often, but sometimes. And you might be one of them sometimes.
Wonderful. Thank you so much. I appreciate it.
Mike, do you have kids?
No, we don't have. I mean, the only thing we really have is a mortgage, and my wife still has student loan interest, and that's pretty much it.
If she's on an income-based repayment for student loans, it may behoove you guys to
That's true,
to
to
do
file
separate
separately.
because then her payments would get lower.
Right.
Okay.
But you would have to look at the answer
So-
to see the savings versus if it does cost you to do separate.
Right. So it's like maybe not a tax thing, but it would be a financial thing. And whenever taxes are involved, it's the overall financial picture that really pays off.
Right. That makes sense. It's just like I said, the last 2 years, federal government, like several $1,000, and we don't really know what wrong because we're both filing married zero. So I was just kind of like, curious
Sure.
as to why this keeps happening.
Sure. Well, again, we'll be very happy to try it for you both ways. That's what you should do. And sometimes it works out. So,
Wonderful.
okay, thanks for your
Thank you so
call.
much.
And we have a text, Tiffany?
We do. It says, Esther, I heard New York State is giving Medicaid to immigrants.
Undocumented.
Immigrants, is that
Yeah,
true?
well, actually, New York state and federal law assures that everyone, regardless of legal status, with or without medical insurance, with or without ability to pay, has the right to emergency medical services in hospitals. Undocumented immigrants are eligible for Medicaid only for the treatment of emergency medical conditions or prenatal care, and that's right from the state of New York. So I read it right off the website.
Right, and I want to just real fast go back to the Mike that we were just talking to. He said they're both claiming married and zero, but the thing is, the new withholding tables, when both spouses work, you have to use that chart in the back. That stupid, I'm over on the left, my wife's over here on the top. Let's see where we go. We meet in the middle, and it will tell you how much extra you have to take out. So it's not like
You mean on the W-4?
On the W-4, yeah. The W-4s have changed totally than what they used to. So
Right.
you really got to fill out the whole thing to make sure you're right where you want to be.
And really what he's saying, what Chris is saying is you're obviously, if you owe money, you're under withholding. So that change in W-4 might be something you want to look at to increase your withholding so you don't owe at the end of the year.
Right.
Right?
Yep.
Okay, let's go to Dave. Hi, Dave. How can we help you?
Hi, Esther. Happy New Year.
Happy New Year to you, too.
Thanks. I bought some mutual funds at the record date around December 27th. And I did get dividends from that. From what I understand, to determine if dividends are common or if they're qualified, you have to hold them 60 days before or after the ex-dividend date or something like that. Do I have to wait then until, say, really late February or March to get my statement from my brokerage?
Yes, I would
determine
never
if
file
they're-
I would not file your return until you get that 1099 form from your broker, because they will have done, it's under federal law on stocks that are acquired, that it's up to them to report the basis, and you're going to find that what you've done in accounting may not equal what they've turned into the Internal Revenue Service, and you certainly don't want that problem.
And it's
I would wait.
Right. Definitely wait for the statement. But to make them qualified dividends, you do have to have the stock for at least 60 days when the dividend was issued. So these dividends you just received will only be ordinary, not qualified.
Right. But they'll have it all figured out on the 1099 DIV for you.
Okay, great.
Okay.
Thank
All right.
you.
Hey, thanks for calling, Dave. Wanted to talk about another change, a good change on the state of New York, knowing that they're giving away Medicaid. Now, the Empire State Child Tax Credit is for children that are. You had to be under the age of over 4 or older in order to get it before. Now it's for all children up to age 17.
Correct.
So,
right.
so that baby is a baby to the 4-year-old where you wouldn't have gotten the Empire State Child Tax Credit. Now you will. So that was a positive change on the New York return.
Yes, for
It
sure.
was interesting because somebody said to me, "Why would the state of New York do that?" And I said, "It's absolutely going to cost them money, but it really was the right thing to do." And then that person said, "Yeah, well, it's expensive having baby. You got diapers and all that stuff." So that's great to see that they did
because
that. So that's a positive change.
Yeah, the question used to be, why don't I get it for my newborn or my
That's
1-year-old?
Exactly right. Exactly right. Okay, and we have another text?
Yep, we do. We sure do. And it's about Venmo. It says, what if I use Venmo to send what if we use Venmo to send your adult kids money? Will they consider this earned income?
All right, Chris, Tiff, you want to answer that?
Well, that's where this $20,000 rule came into play. So if you're just gifting your kids the money, then there is no nothing you have to worry about right now with Venmo. But if you are gifting a total of over $17,000 for 2023, then you do have to fill out what's called the gift tax return. No money is owed, but you have to fill out the form to tell the government you gave from your account to somebody else's account that much money.
But not if it was to pay for your kid's college. I mean, that's not a gift.
Well, if
paying
it was
for your
a
kid's
Ven,
college.
but what that would have be go right to the college. If it was just a Venmo would be to them.
Right.
So it would.
But you're talking about the gift tax return versus the 1099K form.
Correct.
Right? Yeah.
Yep.
So they don't have to worry unless it's more than 200 transactions and over $20,000, right?
Right.
But if it was over $20,000, like let's say they sent their kid $40,000, then they are going to get a 1099K form, and they have to handle that special so that they put the income in and take the income out so that it's reported on the tax return, because otherwise they will get a bill,
Yes.
right?
Yep.
Okay, and we have another text here?
Yeah, do you want to go to Joe before the text, or you want to go
Sure,
to the
we'll go to Joe. Hey, Joe.
Yeah, hey, Esther.
How you
and the
doing?
gang, I don't know. I'm ready for spring.
Oh, It just got cold. I mean, come on.
Yeah, I'm leaving anyways. I'm going. My days are short. But anyways, question being about Social Security. What type of tax are you obligated to pay on Social Security? Is it state and federal?
Well, it's tax-free on the state, but on the federal, are you single or married?
Married.
Okay, so on the federal return, unless your income, taxable income, added to half of your Social Security, when that figure is added up, exceeds $32,000, then nothing is taxable. If it's over $32,000, then the excess over $32,000 starts at half being taxable until it gets to 85%, and that's not a tax, but that's taxable. So you may not owe any tax at all in your Social Security. It depends on how much other income you have.
Oh, okay. Okay. The thing is, so you're saying 85% of the total
Would
Above
be
32,000.
taxable. So if you're in the 10% tax bracket and you're over by $5,000, it would cost you $500 in taxes.
Okay. Okay. Okay.
But
so
if you want to know definitely, give us a jingle. We'll run the numbers for you so that you know. And by the way, people that are thinking about whether or not to start your Social Security withdrawal at age 62, on our website under Social Security, we have a computation that Chris did for us,
Yes.
and we really appreciate. So you can tell how much you would save if you started withdrawing your money on Social Security at age 62 if you qualified, right?
Right.
Oh yeah, yeah. The thing is I see no reason to wait.
Amen.
Yep.
You know, the thing is I don't know. I see so many people not even making it to, you know.
And that's exactly the point, because when you leave the money in Social Security, that money is, you have to, it's about 15 years you have to wait past 70 in order to make up what you didn't get. And they don't come up to your widow and say, oh, honey, you should have gotten $100,000. Here's the money. You lose it. So that is an important, that's an important thing to think about.
Yeah. One other question too, Esther. As far as like you know, if somebody's out of state, you know, the 6 month and a day routine rule. Like say if I was in Florida for 6 months and a day, then I'd be required to file income tax through Florida. Is that the way it would work?
Florida has no tax liability.
No, I mean, but you still have to file federal.
Federal, yeah.
Oh, yeah. I mean, sure. And they'll do the tax return for you in Florida. But it isn't as easy as just saying 6 months and a day, because you would have to have a closer relationship with Florida than New York to be alleviated of the responsibility of not filing as a New York resident. So be very careful. It isn't as simple as that. They don't just let you go because you're there for 6 months and a day.
Your
You'd have to
registration,
have-
your doctor's.
Right.
Your voters, yep.
Absolutely. So all that kind of stuff, you have to prove that, no, I'm really a Florida resident, not a New York resident. And
Well, if I'm-
that can be pretty tedious, I'll tell you.
Well, if I'm
All right.
paying like an HOA fee for the whole year, I mean, that's, and utilities and stuff, that would be. and
Well,
license.
do you own a home in Florida?
I own property down there, yeah.
How about
do you
your
have a home in New York?
Yeah.
So again, it could be the state of New York can take the position that just because you're there one extra day, if you don't have a closer relationship to Florida than New York, they won't let you
Right.
go.
Are you claiming the star exemption up here?
The star exemptions, from what I'm getting now, it's pretty much a joke. So,
But if you're
But are
claiming
you getting it?
if
Right.
you're getting it, that means you're a New York resident.
Yeah, and New York State can.
No, I haven't moved yet. This is probably about a year away.
Oh,
from
okay.
this.
Well, give us a call. We'll be very happy to help you plan, but you need to understand the burden of proof is on you to prove that you have a closer relationship to Florida than New York. So
Yeah,
that means alleviating some of those things, like at your home up here, things of that nature. You have to be careful of.
Your cell phone use, make sure
Right.
they can monitor
Oh,
that.
yeah. They're watching you, huh?
Yeah.
Yep.
Oh, yeah. Oh, yeah. All right. Hey, thanks for calling. I'm Esther Goulias, the tax lady from EG Tax. We're going to take a short break, and we'll be back on the other side with your comments, questions, and calls. Hey, we think of you as family. I hope you think of us as family as well. I'm Esther Goulias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We have somebody that's inquiring about the new BOI FinCEN requirement, right?
Yeah, I might need some help with this. I have a DBA I opened in 2005 in Erie County. I have not done a single penny with it. Also, I have 3 LLCs registered in Nevada, 4 filings in New York State. Have not done anything with 2 of them. The third one is a partner and myself. Have not done anything through it since before the pandemic. Still have to register all of these.
Okay, no, I'm really glad that this was brought up. There are 23 exempt companies that don't have to do this BOI FinCEN, and it would be basically stockbrokers and holding companies and money service businesses and accountants don't have to do it, or public utilities, pooled investment vehicles, tax-exempt entities, 501c3s, large operating companies, and inactive entities.
That's good.
Inactive. So if I were you, taking a look at how they're looking at these financial crimes network and reporting, if you don't need to keep these LLCs going, it might be wise to terminate them. I mean, why give them an opportunity to write you a love letter, right?
Yeah, and I know I've done, every state has a reporting vehicle. For instance, there's some clients of mine that are in Florida, and we have to do reporting to Florida for their corporations. So I'm sure Nevada's got some reporting, and so it's just...
Yeah, but I think that they were referring to the BOI thing.
I know, but I'm
Yeah,
just saying
right?
close it if you don't need
Right.
it.
That's exactly how I feel.
Yeah.
Okay, we got any other texts?
Yeah, there is. Chris, you want to read that?
Sure. Can I deduct part of my personal vehicle usage against rental property? I plan to take a mileage expense, but can I deduct some of the purchase cost of the vehicle?
You can do either or. You can depreciate the vehicle used in business based upon the business usage to total, or you can take the standard mileage rate. I would say probably in your situation, unless you're using it for multiple rentals and you're not using it a lot for making income, it'd probably be better to do the mileage rate, standard mileage rate. But until you put a pencil to it, just like that other caller we had, you'd have to do it both ways to see which way saves you the most money.
Right.
In other words, you don't get to depreciate it and take standard mileage. You do one or the other.
Right, and to deduct the purchase cost would be depreciating the whole
Right.
vehicle over time. So
Right.
And it says, there's a text, it says, for that personal Venmo $40,000, you said. Where would you take it out? What form? Report income.
Okay,
but then
so you
where do
have to
report the personal no gain.
So you report the income under that miscellaneous income section, and then you report the subtraction under the portion of the tax form that lets you take adjustments to income, and you put that explanation on that line that it was just personal money sent to your child.
Is it going to go on a Schedule 1?
Yep.
Yep. Okay,
Yeah.
Schedule 1.
Page 1 for the income, page 2 for the expense. And if you're talking 40,000, I would expect a letter from the IRS saying, please provide the proof.
Right, and that would be real important for you to get your ducks in a row before
Yep.
tax time, right?
Exactly.
Okay, any 8030930, 8030930. Let's see, want to talk about how, yes, ma'am.
Oh, sorry. There's a call coming in, and I'll
Frank's taking
take
it
Frank's
right now.
taking it
Okay,
right
so
now.
just quickly, wages and interest income are taxed as ordinary income. In other words, you pay the highest tax rate on that. But dividends, specifically qualified dividends, like that guy that called a while ago, or was that a text? If you have qualified dividends, you get a special reduction in income tax that you have to pay on something on a dividend. So if you have confidence that you can invest in a company paying dividends and you're going to do as well as in a bank, you would save about 10% max from you, because it'd be 20% max on a dividend versus the rate that you would pay on interest by using dividends as opposed to interest, for instance. So dividends and capital gains have a much lower tax rate than wages and interest.
Right.
All right.
Yep.
And then we have who?
Pat from Amherst.
Pat. Hey, Pat. How can we help you?
Hi, Esther. I called last week. It's a question about Amherst and New York State, the cap for the property tax.
There was I could not find anything. Did you guys find anything?
I couldn't find anything either.
Yeah, so very sorry. I mean, I can't make something happen that I can't find. So
understand.
I'm sorry, Pat.
Find out the legality of that.
Well, I got to believe it's legal, or at least remember, anything they do in government, you can challenge by taking them to court. You're entitled to your day in court. So I got to believe they think it's legal, or else they wouldn't do it unless somebody challenges them.
There's a town meeting challenge in it right now.
Well, there you go. Go to the town meeting.
Okay.
They would know that there was nothing. I looked and looked. There was nothing that I could find.
And you could set a precedent, and so do it, challenge
Yeah,
it.
but that can get expensive, because anytime you challenge something, you're going to pay the attorneys to do that. All right?
Yep.
All right.
And we got Mike
and
from
we got
West
Mike.
End.
Hi, Mike. How can we help you, sir?
I forgot to ask you before, and I've been meaning, how do you know what a qualified dividend is? Does it say on the 1099, like from your broker?
Well, it will say on the 1099, but Chris, give him the nickels and dimes.
Yeah,
here.
yeah. First of all, it's nothing you have to figure out. It's all reported on that 1099 DIV you get from your broker or your individual company. But it's 60 days from your purchase date. You had to hold it 60 days from the issuance of the dividend prior. So after this, your other dividends will be counted as qualified as long as they're not invested in foreign companies. Some mutual funds are invested in foreign companies, which disqualify those dividends from being qualified dividends. So you really got to check with your financial broker to see if these dividends, once you qualify, are going to be qualified or not.
Right, and again, the benefit, of course, is that...
Yes.
Yeah,
Yes, I understand certain parts, but I didn't know about everything would be noted as a qualified dividend if it is.
Correct.
Right, that'll come right on your 1099 DIV.
Okay, thank you.
Okay, Mike, thank you, sir.
There's a text, just out of curiosity. What is the dollar amount for the earned income, whereas you make under a certain amount, you can end up getting money back in your taxes?
Well, that would be your standard deduction, which means we would need to know your filing status.
Well, no,
So-
I think
they're
what they
talking
mean
about
for the earned income
They're talking
credit.
about earned
That's
income
not what
credit.
they're saying.
I agree with
don't.
Esther. I agree
Okay.
with Esther.
Well,
so
anyway,
they're just saying
the earned income credit, if you're single, is at right around 15,000 or less in
Right.
in gross income, of which part of it has to be wages. When you're head of the household with 3 or more children, it's like 65 to 70,000. So it can be quite a lot of money. But that's at the peak of the earned income credit. So the earned income credit, the big earned income credit, is when your income is around $18,000 gross income and have 3 children. 3 or more children.
Every
So,
year that keeps going up and up.
But it does phase out. And remember, it's not only a refund on the federal, but also on New York State. New York State kicks in part of that too. So
Yeah.
anyway, I'm Esther Golias, the tax lady. Our office is open on the 15th of January. The IRS is open for business on the 22nd. Don't file unless you got all your stuff, because you don't want to have to file an amended return. And for those of you that love doing it by paper, think about trying to do it electronically. You would be so happy. I think you would be happy. And until next week, and oh my God, I hope it's Thanksgiving tomorrow night. I'm Esther Golias, the tax lady. Let's hope the Bills win. Until next week, I'm Esther Golias with Tiffany Fabian, Christopher Fabian. And if you need us during the week, give us a jingle. Thanks for listening. Bye-bye.